So, you're thinking about buying a home and you're wondering what is needed to get a mortgage. What are the different aspects of my application that lenders are going to look at to determine whether or not they're going to give me a loan? In this video, I'm going to take you through the 4 areas that underwriters evaluate when deciding whether or not to approve your loan. So if you stick with me to the end, we'll discuss a bonus tip that you definitely don't want to miss, and we're going to get after it right now. If this is your first time to this channel and you want to know everything about financing a home purchase, then subscribe below, tap the bell for notifications so you can be the first to know about updates to the mortgage financing world. My name is John Ritter with Ritter Mortgage Group, and we get calls and emails every day from people just like you looking for help on financing their upcoming move, and we absolutely love it. Now, whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email. All of that information is in the description below, so we can help you make a smooth move to your next home. So, what do you need in order to get a mortgage? Now, before we jump into that, you first need to know that 80 to 85% of all mortgage approvals are done by a computer. In the mortgage industry, we all use an automated underwriting system. Think of it as a software program to determine if a loan will be approved. Fannie Mae has their desktop underwriter and Freddie Mac has their loan product advisor. And the way it works is we just input all of your information into the computer, we hit the button, and it goes to Fannie Mae and Freddie Mac, and it tells us within seconds whether your loan will be approved or not. And it becomes the underwriter's job to verify that the data we put into the computer is accurate, meaning they're going to take a look at the income that was input into the computer and make sure it matches the pay stubs. They're going to take a look at the assets that were put in, and they're going to make sure it matches the bank statements. And as long as everything matches up, you're good to go. Now, that begs the question, what is the computer, what is the algorithm looking for in determining your approval? It's looking at 4 key areas in deciding whether or not you're a good risk and to give you a loan. Now, the first thing that they're going to look at is your credit score. You need a good credit score. A good credit score is crucial, and lenders are going to use this to determine your interest rate. The higher your credit score, the better your interest rate will be. The lower your credit score, the higher your interest rate will be. Lenders are going to use your middle score. You have 3 scores from each of the 3 main credit bureaus. They're going to throw out the high score and the low score, and they're going to use your middle score. Now, if there's more than one person on the application, whether it's 2 of you or 10 of you, the lenders are going to use the lowest middle score out of all the people on the application. Now, what's a good credit score? If you have a score above 760, that's generally considered an excellent score. Anything between, say, 680 and 760 is a good score, very solid. Between 640 and 680 is, an okay score, and less than that is kind of getting to the bottom of things. Many programs and lenders have a minimum requirement of at least a score of 620, but there are some options even down into the 500 range. Now, it's important to know that on a conventional loan, your interest rate is heavily based on your credit score, and it's based on 20-point tiers, meaning the top tier is anything above 760, and then the next tier is 740 to 759, and then the tier below that is 720 to 739. And then below that is 700 to 719, and so on and so on. So it's important to try and get your score as high as possible so you can put yourself in the highest tier for your interest rate. The next area that is analyzed by the algorithm is what we call in our industry as your DTI. Now, that stands for your debt to income ratio. In other words, how much are your income and your expenses? The lenders want to make sure that you're living within your means and you're going to be able to pay them back the money that you borrowed. Now, to give you a simple example, if you make $4,000 a month and your total debt payments are $2,000 a month, then you have a DTI of 50%. Now, obviously, the lower your debt ratio, the better this is going to look in the eyes of the underwriter and the algorithm. Now, if you want to calculate what your debt to income ratio will be, all you need to do is add up the total of your monthly debt expenses, like your car payment, your minimum payments on your credit cards, your student loan payment, any personal loan payments. Add all of those up, and then add on top of that how much you feel comfortable paying for your monthly mortgage payment. And that is going to be the total of your expenses. Now you're going to divide this number by your gross monthly income. That's the amount before taxes are taken out. And that is your DTI. I'm going to give you another example to illustrate. Let's say you have a car payment of $400, a credit card payment of $100, and a student loan payment of $300. So that is $800 in total, and let's say I'm comfortable paying $2,000 for my mortgage payment. That brings the total of my debt payments to $2,800, and let's say my gross monthly income is $7,000. That means my DTI, my debt to income ratio, is 40%. Now if your debt ratio is too high, which generally is anything above 45% is deemed too high, you either need to pay off some debt or find a way to increase your income, which brings us to area number 3, your employment. The key with your employment that the algorithm is going to want to see is that you have a 2-year history of making money. Now, if you just graduated from college, don't worry, the lenders count your education as work experience. So if you just graduated from college and say you're a teacher about to start teaching your first school year, that's okay. Along with the length of your employment is the type of employment you have. Are you a salaried W-2 employee? Do you work hourly? If so, is there any shift differential, or is there a minimum number of hours you're guaranteed? Are you self-employed and you have your own business? Are you an independent contractor? Are you in sales? If so, is your income 100% commission, or do you have a base plus commission? Do you have a housing allowance, car allowance? Do you receive bonuses? Depending on how you make your income is going to determine how long a lender is going to want to look back so they can come up with a consistent average to smooth out any highs and lows in your income. For example, let's say you're in sales and you landed a big sale and you made a nice commission on it. Now, if you do that on a regular basis, then great, it'll get averaged out in your income. But if you only did that once, the lender is going to average that out over 24 months. So for example, let's say your base salary is $50,000 and you made a $50,000 commission. The lender is not going to automatically say that your income is $100,000 a year. If you have a history of making $50,000 in commission year in and year out, then you make $100,000 a year. But if you only made $50,000 in commission one time, the lender is going to average that over 2 years, which means you only get credit for $25,000 per year, and your allowable income will be $75,000. Now there's some other nuances, but this is to help you get a general idea. Now a quick word about part-time jobs. I've had clients over the years, when they found out they didn't make enough money to quite get the home that they wanted, their answer was, no problem, I'll just get a part-time job to push up my income. Well, that's all fine and dandy, but the lenders are not going to count a part-time job unless you have a 2-year history of working 2 jobs. They've done this long enough to know better than to count a recent part-time job that you just picked up, because you could, quite frankly, quit that job as soon as you buy the house. So for those folks that have been doing it all along, the income will be counted, but not for those who just started the part-time job. If you're self-employed or an independent contractor, i.e. 1099, you're going to need to have a 2-year history of that income, documentable by 2 years of federal tax returns. If you have anything less than that, it's going to be very difficult to get approved for a loan. Now the last area that's looked at by the computer is your assets. Now I always recommend to clients to save up as much money as possible so that you can keep as many options on the table as possible. The goal is not to try to use up all of your money, but the goal is to keep as many options on the table as possible, because the more options you have, that always translates to a better monthly payment. Now the assets are going to divide up into 2 different categories. The first category is how much money do you have to put down towards the house that you're buying? Is it 0%, 5%, 10%, 20%, or even 50%? Obviously, the more money you have to put down, the better risk you're going to be. The more money you have to put down means the more skin in the game you have. The less money you have to put down, the less skin in the game you have. Lenders are always looking at things from the worst case scenario perspective. The worst case scenario is they lend you the money, you stop paying on it, and now they have to foreclose and take the house back and then sell it to recoup their money. The more you put down, the easier it is for them to recoup what you borrowed from them. They also know that the more money you put down, the harder you're going to work to keep the house in times of trouble. So for example, let's say you put $50,000 down on a house when you bought it and you hit some unfortunate times. You're going to work harder to get your $50,000 back than if you only put down, say, $5,000. It's a whole lot easier for you to walk away from $5,000 than it is for you to walk away from $50,000. It's a lot easier for you to say, the heck with this, when you've only got $5,000 on the line. Now, the money you put down is your down payment. Lenders look at it as what we call your loan to value, or LTV. How much are you borrowing versus what the house is worth? The lower your LTV, or in other words, the more money you put down, the better risk you are. The higher your LTV, or in other words, the less money you put down, the greater risk you are. Now, the other category under assets that is looked at by the computer is what we call reserves. This is how much money you have left after you purchase the house. So after you pay for your down payment and your closing costs, do you have anything left over? And how much you have left over is measured by reserve. A 1-month reserve is the equivalent of one mortgage payment. So if my mortgage payment is $1,000 and I have $1,000 left over after everything is said and done, then I have 1 month of reserve. If my mortgage payment is $1,000 and I have $10,000 left over, then I have 10 months of reserve. The greater number of months of reserve I have, the better risk I am. The less reserve or no reserve I have, the greater risk I am. Now, reserves do not have to be cash in the bank. It can be things like your 401k or your 403b. It can be investment accounts, CDs, IRAs, and so on. And reserves also do not have to be kept during the whole time you have the mortgage. It's simply just a snapshot of what you have at the time you close on your house. And remember, the more, the better. So we've talked about the 4 areas: your credit, your DTI, income and expenses, your employment, and your assets, your loan to value and reserves. The stronger you are in these 4 key areas, the more likely your loan application will be approved. Now here's the bonus tip for sticking with me till the end here. You don't have to be strong in all 4 areas to get approved. It certainly doesn't hurt, but the stronger you are in one area, the weaker you can be in other areas. So for example, let's say you have top tier credit, but you don't have much money to put down. That's okay. Your credit score is the leg you can stand on. Or let's say you don't have good credit, but you have 50% to put down. That speaks volumes to the bank and to the algorithm, and that's your leg to stand on. Or maybe you have a decent score, but you don't make a whole lot of income. That good credit score can allow your debt ratio to be higher than it would be if you had a poor credit score. The bottom line is, make sure you're strong in these 4 areas as much as possible to make your loan approval as simple as possible. Now, if you'd like a formal pre-approval done for you and for your family to see if you have what you need to get a mortgage, reach out via the contact information below. If you found this video helpful, please give it a thumbs up, share it with your friends and family, and don't forget, subscribe for more mortgage insights. Until next time, happy house hunting.